Have you ever got caught out in a breakout that you thought would go wild and you were already dreaming of making a big profit out of it, only to see it turn into a fake breakout? I know this must have definitely happened with you, and yes, it feels bad when you are planning for this trade for a long time only to get stopped out by the price. And that's not even the worst part. The worst part is you get stopped out by the fake out, and then it again gives a breakout which you hesitate to enter, and the price goes wild. Hello and welcome to Forex Monopoly. My name is Daksh, and in this video I will tell you the 4 ways to avoid false breakouts which hardly anyone ever talks about. So stay attentive and watch this video till the end if you don't want to lose a single penny in false breakout. Now, before I tell you the ways, let me first give a brief about what a breakout and fake breakout is, and most importantly, how are they formed, as this is going to be very helpful when I tell you the ways to avoid it or tackle it. So, a breakout is basically price getting out and breaching a particular price level on the price chart that was acting as a resistance or a support. Like if you open up a price chart and notice the price movement, you will find a point on the chart where the price faces difficulty to cross. Price may bounce off from it multiple times before finally breaching it and breaking out from it. And when it does, we call it a breakout. Now, a false breakout, yes, you guessed it right, is a breakout that failed to play out. For instance, consider that a bullish flag pattern is formed and the price is facing resistance from a particular price level. Now the price finally moves above the resistance, maybe spends some time outside the pattern, but then it falls back right into the flag. This is a breakout that failed to play out, and it is what we know as a false breakout. Traders have many ways to justify this, and they have varied opinions on such false breakouts, but keep watching ahead to know why such price action occurs and what the truth is. So, the Forex market is made up of 2 different types of participants: the retail players and the institutional players. The retail players like you and me participate in the market with a relatively tiny amount in the comparison to what the institutional players participate with. The amount they have at their disposal is so huge that they cannot trade as easily as we do. Large capitals means bigger positions, and in order to build such a large position, they need liquidity in the market to get their orders filled. And they get this liquidity from orders placed by other institutional players as well as the orders the retail players like me and you place. So whenever the price is moving in a range, there will be traders who prematurely place buy orders above the resistance or sell orders below the support, and even if the price is still in the range. Hence, at times when we see false breakouts, it is just a liquidity grab by the big players, or the whales as I like to call them. Now, many retail traders have lost money in such price moves, and they go on to blame the market and the brokers for the same. They claim that the market and the brokers are conspiring against them in order to take their money. Now, even if they knew that it wasn't that and was actually a liquidity grab, they will still not accept it and play the blame game. Instead of doing so, I would sincerely suggest you that find ways to avoid falling for such price action, because there are proven ways to avoid such false breakouts, but sadly not much of it is talked about. But you are in luck, as I'm going to mention 4 ways which will help you avoid losing your money in such false breakouts. But before we move forward, if you are enjoying this video, make sure you hit that like button. The first way is wait for the candlestick to close. Whenever you see price in a range or price action inside a pattern and you anticipate a breakout, have some patience. Patience pays. If you see that the price has crossed the breakout level, do not straight away jump into the trade. You should wait for the price or the candle to close either above the resistance or below the support. Take a long trade only if the price or the candle closes above the resistance, and a short trade if the price closes below support. By doing so, you will drastically save yourself from getting caught in breakouts that weren't going to play out as proper breakouts. You must have noticed wicks being formed that extend outside the range. These are where traders get caught. There will always be a next candlestick that can be a breakout candlestick, and you can always take breakout entries once such price action takes place. So sit back and wait for the candlestick to close and never enter trade while the candlestick is being formed. The second way is wait for the price to clear the closest resistance or support. Now, let's suppose you have been tracking a currency pair for some time now, and you see that the price is creating a bearish pennant. The price then went on to break out of the pattern and started moving down. In the path of the price, there is a price level that could act as a support. And during such times, if the support is very near to the breakout level where your entry would be, wait for the price to break below the support. And if after the breakout the support is a bit far away, then close at least a few percentage of your position at that point. And the same would be the case if the price breaks out of a pattern or a trend line to the upside and there is a resistance just close to it. These price level will have some effect on the price action, and it might just be a hindrance in the breakouts. This is because many traders may have sell orders placed at the resistance, and if that liquidity is not grabbed by the buyers, the price may move down, and many times you may notice that there is a support or a resistance level that drives the price in the opposite direction after the breakouts. Whenever you see a breakout, you need to have a clear path for the price to move into. If there are roadblocks, then you should be cautious and take different steps to deal with it. Now, the next way is again a very important one and will help you get rid of the fake breakouts right away. So make sure you pay attention to this. So the third way is look for the breakouts on the highest time frames. Now, you might be a trader who trades based on 1 hour time frame or the 4 hour time frame, and you spot a breakout taking place on these time frames. So before you react to this and take an entry, what I want you to do is move to the higher time frame and see if the setup you are trading is valid on those time frames. And if a breakout is taking place on a smaller time frames, then it is possible that it could be spotted on the higher time frames too. And if there is a level that has not been broken on the higher time frame, then you should be cautious, be patient about the trade. The higher time frames are always superior, and the higher you go, the better the trades are. Now, many of you might say that if we wait for the price to break out on a higher time frame, the price will move far away from your entry and your risk to reward will be affected. No, that's not the case. In such times, what you can do is you can always wait for the price to form a build-up or a small range or a retest and then enter. And by doing so, you can again get a good risk to reward ratio. And even if you miss a trade, that's okay. It's okay to miss a trade and be patient than to lose one and regret it. Now, here we are at the most important thing and the best way to avoid getting stopped out by false breakout. Number 4 is place your stop loss at the right place. Yes, placing a perfect stop loss will help you avoid the fake breakout. You always have to place stop loss in such a way that when you get stopped out, the entire setup gets invalidated. And doing this ensures two things. You are proved wrong, that is, you get to accept that your analysis was wrong and you can move on. And if there is a fake breakout, your stop loss will be at such a place that if after the fake breakout the trades move in your desired direction, you will get to profit from it. So what is the right place on the price chart to place stop loss at when trading breakouts? For instance, if the price is moving in a range in a channel and it breaks out of it to the downside, where should the stop loss be placed? It should be placed at the opposite side of the range, and in this case it will be placed few pips above the resistance or the liquidity gap area, or at a level where you think if the price moves then the pattern will be invalidated. Many traders place their stop loss at the price level inside the range or pattern after they take entry on a breakout. Now this might make their risk to reward ratio attractive, but it also causes some problems for them. If you place your stop loss somewhere inside the range or pattern, you will become vulnerable in cases of false breakouts. The price can always break out of the range and fall back into it, and in such cases your trade hasn't been invalidated completely as of yet, as the price hasn't still breached the opposite side of the range. You should place your stop loss at such a level which, if triggered, will make it clear to you that you were wrong in your analysis and you weren't just kicked out by a wick. Now if you manage to place your stop loss at the right place, then you can save yourself from getting caught in false breakouts. And even if the breakout fails and the price comes back into the range, it can always break out again and you can still be in the trade and ride the breakout.